Hello, welcome to Doss Law. My name is Dennis Doss. I'm General Manager of Doss Law. Before I begin my presentation today about mortgage pools, let me tell you a little bit about our law firm. Our law firm was formed in 1983 and has always been right here in the Irvine, Newport Beach area. We're located very close to the John Wayne Airport. Our firm is very unique in that we're very specialized and focus almost entirely on the representation of mortgage lenders. Those mortgage lenders could be very, very small companies up to large public companies. For those mortgage lenders, we provide a very wide variety of services, including formation, licensing, compliance with consumer credit laws, loan documentation, commercial loan closings, employment matters. We also handle litigation and what we're here to talk about today, which are mortgage pools or mortgage-backed securities. Our firm is the largest creator of mortgage pools in the United States, at least that I'm aware of. In 2005, we created approximately 47 new mortgage pools, amounting to about $5 billion worth of mortgage pool securities approved for sale. What makes us, I think, different is our innovation, for one, and two, our efficiency. When you do a lot of mortgage pools, you'll learn the tricks of the trade, you understand the efficiencies, and the way we practice, I think, reflects that. The way I broke up my presentation is to basically pretend that you're asking me 6 questions. The questions are, do I want a mortgage pool? This is you talking to me. Do my private investors want one? How do they work? Show me how the parts move. Can I do one in my state if I do want to do one? If I have one, what are going to be the challenges to running one on a day-to-day basis? And if I am interested, how do I go about getting started? Let's start with the first point. Why do I want a mortgage pool? Why would you as an originator want one? And there are several reasons why I think you should consider one. The first and foremost that I hear from clients time and time again is the diversification that a mortgage pool provides. It is the first rule of investing. Don't put your eggs in one basket. Diversify what you do. If your portfolio is diversified and your investors are investing in a small piece of a large group of mortgages, their risk is greatly diminished. The best example of that is a case we had in our firm about 2 years ago. A mortgage broker had sold 29 mortgages to a private investor, and they all performed admirably. Of course, number 30 did not and drew a claim. And we succeeded in defeating the claim, but claims cost attorney's fees. Had that same mortgage originator put all 30 of those loans into one mortgage pool, he would have been judged by the average of his performance, not by just the worst loan that he did with that investor. So that diversification is very, very important and is very protective of you. In a mortgage pool, you can have some defaults, you can have some non-performing loans, and they still produce cash flow. And you don't get the backup phone calls from investors asking where their monthly payments are. The second real important point is that it adds up to a one-time sale. The biggest frustration I get from clients who don't have mortgage pools is the massive amount of paperwork they have to provide to their investors as part of their due diligence process. I'm not faulting them for that, but it's a very tedious process. With a mortgage pool, it's a one-time sale. The investor puts their money into the pool, that money rolls over and over again, and the investor is not involved in micromanaging each underwriting and loan decision. The third major reason is fast loan funding. Fast loan funding equals more deals, in short. If you're known in your community as someone who has the financial strength to make loans and close them quickly, you're going to be the go-to guy or gal in your neighborhood. That's very important and makes you more efficient. Fourth reason is you get to underwrite the deals. That doesn't mean you've got carte blanche to do anything you want. Your offering documents will describe point by point the rules that you must live by in making mortgages on behalf of the mortgage pool. But you don't have to go out and meet with the investors, present the package, buy them lunch, and go through this tedious, slow process and have them look at your deals and second guess them. The fifth reason is very, very important to your investors. Many of them are retirees, many of them are on fixed incomes. They don't need a roller coaster in the way of income with borrowers paying one month and not paying another. A mortgage pool, because of the large number of mortgages that you end up in one, produces a very steady, predictable yield to the investors. Every month they go out to their mailbox, There is a check for a predictable amount of money. They don't complain. They don't congratulate you, frankly, either, but it makes you much more efficient. And the sixth reason is flexible growth. You may want to build an empire and grow a very large mortgage fund, and you may want to grow a small one or actually downsize it. The mortgage fund gives you that ability. They all start off with zero, and the sky is the limit. So they can go to 100 million or even higher. We have several clients well over $100 million worth of mortgage pools. Okay, the seventh reason is less government regulation. Makes it easier to raise capital. A mortgage pool, most of them are formed, they exist, there's no government regulation of how they're created. You have to rely upon us and we have to rely upon you to provide truthful information to your investors and to follow the rules of the law in creating these mortgage pools. But there isn't the constant eye of the government looking at your mortgage pools, provided you're running them correctly and doing the things that the documents require. Eighth and last, a mortgage pool gives you the ability to do larger loans, which means more income to you. Because you've got this collection of capital, and hopefully you've got investors waiting to come into your fund, at any given point in time, you can make larger loans and earn larger commissions and reach a wider marketplace from the small loan to the larger loans. So that in a nutshell are the reasons why I think you might want a mortgage pool.
When I connected with Dennis and his team about 3 years ago, I had 15 investors and $2 million in a small Reg D fund. And Dennis introduced me to and then later helped me create a mortgage pool using a California securities permit. And since then, we've been able to grow to over 400 investors with about $50 million in equity. The mortgage pool that Dennis helped me create is really terrific because I'm no longer at the whim of Wall Street underwriting standards. I can create a great product for my borrower, and it's really a win-win product for us.
Additionally, from a company standpoint, it's been very beneficial. It's cut down on our paperwork, and it's also improved or cut down on our investor communications. Whereas before we would have to talk to each investor about each individual deal, now we simply talk to all the investors about the performance of the pool. So it's much easier. Additionally, it's easier to make the loans. So now we focus more on quality underwriting as well as raising capital. One thing a fund will not do is hide your sins. You have to be more careful with the fund with your underwriting, and you've got to be very careful to deliver good performance because it's now become our livelihood, and a mistake in the fund is going to get to all your investors all at once rather than a couple few that happen to have a bad loan. But all in all, the benefits of the fund far outweigh any startup costs or any of the negatives that we're involved with, and I would highly recommend it to anybody.
Now let's focus on why would your private investors want one? And some of these reasons are very, very similar. The first is diversification. We covered that already. That makes their capital safe. Second, less paperwork. A lot of you mortgage brokers think that your investors love your beautiful packages that cost you probably $25, $30 a copy with all the color binding and the like. Strangely enough, if you ask your investors whether they keep those, whether they collect them, they would probably tell you they'd rather not have them. So less paperwork makes you more efficient, makes life a little easier for them. Third reason is their money is working 365 days a year. There's no downtime between loans. One of the most frustrating things that investors tell me about is the broker sent me back the proceeds of a loan that paid off, and then I had to hound him over and over again. When is he going to give me another deal? When can I have another deal? And if you look at their yield fractionalized over the period of a year, it's actually quite modest compared to a mortgage pool where their money is working 365 days a year. The fourth reason is related to safety of capital. We require that all of our funds be CPA audited every year. That audit report gets sent to the investors, and they get the comfort of having another professional set of eyes look at those numbers and verify the reality of them. Fifth is the flexibility your investors get by having the ability to have two accounts within the fund. One that produces a steady cash flow and some number they need for their household needs, and the second account for automatically reinvestment or rolling the money back into the fund without any delay in sending the money to them and getting it back. Sixth, The fund does provide some liquidity. They're not ATM machines, but because of the massive amounts of money coming in and going out of them, there usually is cash flow to pay someone out of the fund at some measured pace. That's something we actually go through in a lot more detail when we work on the architecture of your fund. Last, predictability of income is equal to peace of mind. The investors want to be able to know that when they open that mailbox, that check will be there, ready to deposit in the bank, and there will be no surprises. So those are some of the reasons why I think your private investors would like a mortgage pool, and again, why you should consider one.
At the end of each meeting, Dennis would ask me when he's going to allow me to create a pool. After several years of procrastination, I had Dennis move forward. We don't have the Department of Real Estate looming over us. My staff has a lot less paperwork, and my investors are much more secure because their risk is spread out over several different trust deeds. I would recommend the pool for other people.
Next, let's go to the board and let me show you how mortgage pools work. My clients like this. I've done this many, many times in my conference room. They like pictures. So I'm going to draw you a picture. Okay, let's begin. First of all, a mortgage pool is a legal entity. It could be either a limited partnership or a limited liability company. Typically, it's a limited liability company. Let's call our specific mortgage LLC. Now, the limited liability company has two classes of membership. The normal members are your investors, and then the other member is the manager. We'll call that your co. Your function is to run the mortgage pool, take care of the investors, make the underwriting decision. At the same time, your mortgage company is on its own, and acts as a traffic cop. Loan applications come in to your company, and you act as the policeman to determine whether they go to the mortgage fund, whether they go to a private individual, or whether they go to an institutional source. We'll call it a bank. You typically get compensated in two ways. Most important way are points and fees. And you're getting those whether or not you're brokering the loan to the bank, to the private individual, or to the mortgage fund. The second source of compensation, and before I go on, these are typically paid directly out of your closings. So they're not income that runs through the mortgage fund itself. Your second major source of income is servicing and management. This would include some spread, usually 1 to 3% of the interest rate spread, and ancillary servicing income such as late charges, default interest, prepayment penalties, and the like. You should budget, if you are turning your money over every 2 years, that you'll probably make, and you're not making high cost mortgages, probably about 3% on the total assets managed. So if that's $100 million, that would be $3 million income to the manager on this side of the operation, the loan origination. And then you should figure you're probably going to make somewhere around 3% on the servicing and management aspect of your mortgage fund. Like I indicated earlier, the members or investors have the choice of cash flow or automatic reinvestment. This gives them options. Other features you'll see in our mortgage funds is what I call a parking lot. This is either money in an account or subscription agreements from people who want to come into the fund to give you good liquidity. Other features of the fund, this fund has the ability to leverage its mortgage assets. Typically today, we can put you in contact with vendors that will take your dollar worth of mortgage loans and give you a $5 line of credit secured by good quality mortgage loans. Other features of the mortgage fund, of course, is the annual audit. We talked about that earlier. Lastly, most mortgage funds have very little expense within the fund itself. The manager, because the manager is collecting the points and fees and taking the servicing and management fees, bears nearly all of the expenses of the fund with a few exceptions. One would be any type of limited liability tax, the cost of the annual audit, the cost of tax return preparation for the tax return of this entity. We also will encourage you to create a loan loss reserve. This is a kind of a shave off the income otherwise payable to the investor to set aside for potential losses down the road. The objective of the mortgage fund, and your objective in running one, is to gain some momentum. That momentum will pick up after your annual audit. You now have the CPA audited results that you can show your potential investors. And from that, it picks up steam. What you're also trying to do as you manage the first year of your mortgage fund, and even the second year, is gear it towards what I call the President's Letter. This is the letter that goes out with the CPA audit, typically in February or March, well before the investor's tax returns are due. And in it, you will describe what the fund has done during the prior calendar year. Its weighted loan to value ratios, its default rates, its rate of return, the number of people who requested money that got it out, the number of people that came into the fund, the average loan size, all these very interesting statistics that give your investors a lot of comfort. So that's what you're really trying to gear your mortgage fund to. It is possible within the fund, as I mentioned earlier, for investors to get some capital out. It's usually done on a best efforts basis. It's not a fire drill. We're not going to shut the fund down in order to take care of one investor, but it's done at a measured pace as cash flow allows. Now, there's a lot more moving parts and complexity, but this should give you just a kind of a simple big picture of how it's created. Relatively simple. An entity, your company runs that entity, runs its mortgage company outside that entity, in essence wears two hats. The members have this flexibility. You see where your compensation comes from those sources. So that, in the very simplest sense, is how a mortgage fund works.
We at Reprop Financial have been toying with a mortgage pool for a few years now. We had grown the business substantially and have been fractionalizing our loans. We talked to a number of law firms, and we decided on Doss Law, not only because of the great law work that they do, but because they're great communicators. When it came to explaining the pool to my associates, my firm, to others that I needed to do business with, they were able to do that seamlessly. In addition, we liked the idea that they had a fixed price for each of the services they offered us, so that I knew we could spend as much time as we needed working on the pool and other ancillary operations and still get the same good service. So what's interesting is that Dennis also helped us move into a leveraged pool, and in doing that, we had to move a number of our investors back out of the pool. And the interesting part of this story is that my office staff went back to fractionalizing some investors, almost killed me. The point is that the mortgage pool is the way to go. It's really well done at Doss Law. Highly recommend them.
All right. Your next question's got to be, can I do one in my state? Mortgage pools and the securities that are issued from them are securities, much like stocks and bonds. You have both a federal government that has a concern with raising money from the investing public in the United States, and you've got states that are interested and concerned about raising money from the residents of their state. The rule that we use very frequently is SEC Regulation D, Rule 506. This is a law that was passed by Congress that basically says if you follow the rules of this Regulation D, you have the opportunity to preempt or displace state laws requiring you to register your securities. There may be a notice filing in those states, but you don't have to go to each state regulator to get their permission. This gives you the ability to raise money in all 50 states, which is very important to some of our clients. The negative part of it is that it's limited to accredited investors. These are individuals with an income of $200,000 or more, a net worth of $1 million or more, but you are allowed 35 unaccredited investors. I call that kind of the family and friends exception. It allows you to lend money in all 50 states. Don't forget, you may need a lending license in those states. This does not displace lending license laws. Another kind of a limitation on it is you are not allowed to advertise. The statute actually says general solicitation. So you can't do radio, TV, those type of mass media. You can invite people who are accredited to presentations and make one-on-one phone calls and the like. The other alternative is to actually go to your state regulator, and this is something we do frequently in California, and get a permit or an approval to actually issue your securities in that state. It may not be easy in your state. In California, given the volume that we do, it's pretty much a very predictable process of approval. In your state, it might be a very tough road to hoe. It probably would give you the ability to advertise in the newspaper, radio, TV, and that might be worthwhile considering the hassle of actually going through and getting government approval. You also may face some restrictions on the duration of your offering. The Reg D offerings don't have a duration. The state-approved offerings typically have a 1 or 2 year approval process, after which you have to go back and get reapproved. On the other hand, you do pick up what I call lower suitability standards. You can come way down from the $1 million net worth individuals into people with a lower net worth.
We've been affiliated with Dennis Doss and Doss Law for approximately 20 years. 3 years ago, we began looking at the possibility of obtaining a consumer finance lender license and a mutual fund permit, which would then allow us to get into the mortgage pool or the mortgage fund concept. Today, the fund is up and running, and it's been met with great success and great reception by our private lenders. And we would wholeheartedly recommend anyone going into this facet of the mortgage business to look at Doss Law as the vehicle that will allow them to get their approvals. They were a delight to work with, and I would wholeheartedly recommend them to anyone.
Okay, the fifth question you have to be asking yourself is, Dennis, what are the challenges to running a mortgage pool? There are some. The first I've listed here is accounting. The mortgage pools are accrual basis taxpayers, which means that you've got to get a little bit in tune with accrual accounting. For example, our pools typically have just very few expenses. Most of everything is borne by the manager, but one of them is an annual CPA audit. That expense, let's say, is $15,000 a year. On an accrual basis, you would take 1/12 of that $15,000 and charge it against income every month, even though you're not paying the CPA until the very end of the year. So getting used to that is a bit of a challenge for people who are not used to it. Fortunately, there are 2 software vendors who do provide pool accounting software that will generate your investor checks, do your internal accounting, and things like that. So you're not actually out there blind and without some help and guidance. And of course, we're here to help you as well. Second one is managing cash flows. You can imagine there's a lot of moving parts here. You've got money coming in from investors. You've got money going out on new loans, your pipeline. You've got payments coming in from borrowers of interest. You've got payoffs coming in from borrowers. And all of that has to be considered, spreadsheeted once a month, and you have to manage that. You don't want to have a lot of cash sitting around that's basically sitting there idle, but you also want to have money ready to come into your fund for the larger loans and for the immediate funding ability. So if you're good with managing cash flows, then you're going to be fine with a mortgage pool. The third challenge, as I've seen it, is investor education. Many of my clients have for years and years preached to their clients the mortgage or deed of trust, and that gives you some measure of security. You have to re-educate your investors about the benefits and the safety they can get from a mortgage pool versus having their name on a security instrument in the county recorder's office. Most of my clients have met with very good response from their private investors, and they've been able to re-educate them. Lastly, pension plan investment is somewhat limited in a mortgage pool to 20% of total pool assets. So if all your clients are mortgage pools, you may not be able to get them all of their money into the mortgage pool, but a good percentage of it.
I highly recommend them. It's a great way to use your business, to do your business. The benefits to a fund is that you've got a large diversification of a pool. Your investors aren't tied to any one deed of trust. There's also, you have the ability to direct the dollars where they go. It's a great lending alternative as opposed to fractionalized deed of trust lending. I started working with Dennis 3 or 4 years ago. It was very simple to get the fund structured. They did all the paperwork. You come to them with a general business idea of what you want to do and how you want to do it, and they'll structure your fund that will meet your business practice. They do all the paperwork, they do all the documentation, they do all the filings. They're proficient in just about every state. I've got Dennis working on 1 or 2 different states for me now. And the general benefits to a fund is, again, diversification that you wouldn't get on a single loan. You have liquidity in a fund that you wouldn't have on a single loan. You can use that fund as an asset, take it to a bank, and get a revolving line of credit based on the fund, which you can't do with a single deed of trust. I've had great success with it. I highly recommend it, and I highly recommend that you use Dennis when you're exploring your new pool.
6th, if I'm interested in a mortgage pool, Dennis, how do I get started? What we normally do is don't ask clients to commit to the thousands of dollars in a mortgage pool costs right off the bat. They actually normally hire us at our normally hourly rates to have a further discussion about the mortgage pool, make sure it's a good fit before they make the commitment to actually go forward with one. All of our mortgage pools are done at fixed prices, so there's no surprises. Those prices include the formation of the entities that you need, creating all the documents you need for your offering, the private placement memorandum, the offering circular, the subscription agreements. It includes the consulting. Most of our clients like that fixed price thing because there's no surprises, and they can pay the cost of the pool over usually 3 installments. If after talking to us, you decide you do want to go forward with a mortgage pool, the most important thing I have to tell you today is we're there to help you through that process. We have a good staff of very seasoned lawyers and paralegals that will help you through each step of the process. It begins with a kickoff meeting or telephone conference with me and one of the other senior lawyers. We then do a very thorough due diligence process on you, your company. All of this is important for disclosure purposes. We then craft this mortgage pool in a way that you will like it, that will fit you and work for your business needs. We're also there to help you with vendors. And what are your choices in terms of loan servicing, mortgage pool servicing, and loan documentation, and issues like that. We want to help you through the whole package and make it a very pleasant experience for you. So thank you for listening to my presentation today. I hope to hear from you soon. Here's my contact information. We'd love to work with you on this or any other legal needs in the mortgage area. Thank you.
It's really great to work with a specialist because when you call them, they've already been through the problem you're having many times before, and they have several different answers and can guide you down several possible solutions. You're not going to have to wait for them to do research. They're not going to have to talk with, 4 different associates. You're going to get an answer quickly, and you're going to get the correct answer. There's a lot of law firms that can create offering memorandums and mortgage pools, but there are very few that can do it as quickly and efficiently as Doss Law.
Throughout the years, Dennis has been very good at providing charts and checklists that have enabled us to get through the complex legislation that sometimes comes down in our industry. And because he represents a lot of real estate mortgage lenders, he's been able to effectively, very cost-effectively, give us helpful hints as to which way and what practices might be better for us. Additionally, we once had a problematic arbitration that he was able to solve very successfully in a short amount of time, and that was a lot better for us than a protracted litigation in which nobody would have won in this particular instance.
I've used Dennis not only for my pool investment, but another number of different issues as well. He did my construction loan documents. He's done my commercial loan documents. If I had a particular problem on a type of loan before I wrote the loan, I would call Dennis and ask his advice or opinion as to how to do it or how to structure a particular loan. In every case, Dennis is extremely knowledgeable, extremely efficient, and can really dissect whatever problem you might have. I've also used Dennis for some minor litigation with the Department of Real Estate, and in every area Dennis has an expertise to this lending. He's a very knowledgeable expert in the field of lending, whether it's truth in lending laws or ERISA or whatever problem you might have. I would highly recommend using Doss Law for any problems that you might have.